Hello and welcome to the course. In this video, we're going to talk about navigating the TradingView interface. TradingView is just head and shoulders above most software that you can get, including some that cost several $100s a month. Certainly is, as far as retail platforms are concerned that are readily available, extraordinarily flexible. So with that, let's jump into a chart right away. I just click on stocks. Tesla, I'm sure is probably the most popular stock. You can see I click on launch chart and open that up. With this, you can see that I have a chart here. Pretty straightforward. There are a couple of bars that you need to pay attention to. So for example, there's the top bar and you can change your symbol there. You can, for example, let's type in Q, and then, like if you wanted to switch to Invesco Qs for the NASDAQ 100 ETF, you could do that. For now, I'll leave that be. And notice that there are intervals here, so 5-minute charts, so each candlestick represents 5 minutes. You can change those candlesticks to bars. You can change them for lines. So, I'm using the mouse, wheel right now to scroll in and out, to show the, market from a, higher, kind of like 30,000 foot view. The top bar also features, you can have indicator templates. You can look for indicators. So, for example, and I have some that are already saved, but if I wanted to do, pivot points, high and low, so I could click on that, and it will bring that up on the chart, and you can see that those all pop up. I also can make it disappear. You'll notice that I have volume off. Click on the eyeball, comes back on. You can X out, so that completely is removed. I've got moving averages over here that I can turn on, and you can see that they do pop up. That of course comes down to what style you want to trade, but very easily accessible. A sell and a buy button here, and this tells you the spread. Right now there's a 3 to 5 cent spread. Just kind of depends on, when you get involved. Time frames, of course, can give you an idea of what the market's doing longer term. And then, 5-minute chart, you can even add others. So if you click on the star, it'll add the 1-minute interval to your chart, for example. And if you decide that you want to go with candles, it will draw those out for you. You can see what Tesla's been doing during the day. You even have the ability to go down to the second. And as a result, there's also ranges, which comes down to how it moves. Really, though, it's very rare that traders use anything lower than 5 minutes, of course, as a retail trader. So each market behaves the same. So let's just go to, forex. Let's just go to forex. Get rid of this. We'll go to the euro. Click on that. Go ahead and clear objects. But evidently last time I was on this, I drew a couple tools. So let's go ahead and remove drawings. You can see they disappear after right clicking. That easily pulls up that menu and you just have at it. The market, of course, is dynamic, and you'll always want to be able to kind of keep an eye on how things are going. So you can click on this notifications, and your notifications will pop up at this menu. You can X out of it if you have any in the past. You can also if you go over here with your mouse and you see this little plus, you can click the plus there and you can add an alert. So if you add an alert there, you can have it ding. It can tell you, like if the euro crosses the 1.10474 level, for example, you can X out of that. You want it deleted? Sure. You can also create a watch list, and that's what this little icon is over here. So, for example, this is on the watch list. Let's say I wanted to add one, so you just click on an add symbol. Say I want the British pound. Yeah, so let's add that. You can also take it off by clicking the X, so you'll notice that the British pound is there. These expand and contract so that you can read them, but let me go ahead and go back to the add symbol. Just X out of there, and the British pound disappears. There are also, there's your alerts. So, like in the past, those alerts have been triggered. This would be your data window. So, for example, every time you go on top of a candlestick, it'll tell you how much it changed. Doesn't matter if it's day or if it's night. You can see where the EMA is, for example. You can also see what the volume is. So the data window does give you quite a bit of information. Object tree and data window. So the object tree just shows the order of all of the objects. Hot list. So a hot list is a little bit different than a watch list in the fact that it doesn't necessarily have to be on your list. Volume gainers, for example, in the stock market. There's the calendar, economic calendar, so it will pull up and it will tell you all of the news. You can customize it by clicking on this. So, for example, if you are only trading the U.S. stock market, you may only want U.S. data. So you can choose all of that. My ideas. So you can create and publish an idea to the community. Over here, there are chats, and ideas stream. So you can follow people. It's basically like Twitter. And then streams. People have live streams. So there's a lot of different things that pop up on this side window. The left-hand sidebar has most of your markups. So, for example, and we'll talk about this a little later, but you can click on this in this little sub-menu, and you can add like a flat top, flat bottom. So like an actual range that you can trade. That maybe you have noticed the market bouncing around in. You can change the color here of the line, for example. The fill here to be shown by this, make it blue. You could also change the opacity. I mean, you can make it look however you want. And of course you can delete it like that. There are a lot of other tools that, quite frankly, would take its own course just to go through it. But, for example, there's a highlighter here. If you want to highlight, click on the arrow, go back to the pointer, and that stays there. Basically, as a general rule of thumb, you can erase anything on the chart just by simply clicking on it. You'll see those dots appear. So let me go ahead and do that again. So you see those dots. Now let me go into the pointer, click on that. But once I hover over it, I can click on that. It activates that and I can remove it. The symbol search, like I said, pulls it up. And the nice thing is it pulls it up in sections. So like all crypto. So for example, Bitcoin. You can see that we have shown this on the daily time frame. Say we want to see it on the 30-minute. Again, I can create an alert there. It'll take a second and then it'll pop up. I can hover over that and X out of it. Do I want to delete it? Yes. And it'll just create a little dinging sound. There are some other sounds that you can go into it with, but really it's a personal preference thing. So this is a very robust platform. You can even write on it, click on text, and you can say best text. I'll make it bold, make it bold, make it bold and italic. Okay, and you can see it pops up there. So just a great tool to mark up your charts on and showing how to kind of flip through the various bits and pieces of information. You can change down here like 1 month in 30-minute intervals. So this is what Bitcoin's been doing for the last month. Oh, just the last year, 5 years, and the entirety. This would be, in this case, 1 month intervals, Bitcoin, of course, being a relatively new asset. But let's say we go back to, I think it's something kind of old. General Motors. If you go to all, then it's going to be 1 month intervals, and it goes all the way back to 2011. Could go back further on some charts, but as a general rule, you get about 15 years data on most of your assets. So in the next video, we'll actually talk about these candlesticks here, like how to read them, how to go ahead and use them as information on these charts. Also, we'll talk about customizing them for your liking, but this was just a quick overview with your indicators here, your time up here, your watch list and alerts information over here, and you can set the length of the chart down here. But remember, the interval trumps the length. Hello and welcome back to the course. In this video, let's start to take a look at candlesticks. Now, candlesticks are exactly what you see in front of you. They're various sizes and shapes, and they have wicks and all this other neat stuff that makes them a little bit more interesting than, like a simple line chart. A line chart's probably what you're used to, as it is the most simple way to display information. A line chart will take the closing price of an asset, in this case General Motors on the daily chart, and it will put a dot at that price. And then it will take a line and connect all of those dots, and as price rises and falls, that's what you get. Now, having said that, it gives you an idea what the market's doing longer term, but it doesn't tell you a lot of information that a candlestick will show you. So let me go ahead and turn this back to candlesticks. Candlesticks are a variation on the bar chart. Matter of fact, I will show the bar chart first, just to give you an idea. And bar charts show the range of the day. So let me go ahead and zoom on this candlestick this bar since it's so big. So the range of the day was from there to there, the length or height, I should say, of the bar. So the lowest price was the lowest part of the bar. The highest price was the highest. Pretty straightforward. The opening price always is on the left, and the closing price is on the right. But we start here. We may have drifted a little bit lower, shot much higher, and closed towards the highs. In this case, we started here, we shot a little higher, and then fell and closed here at a lower price during the day. Now, the way this bar chart is set up is if it is a positive day, it will turn green. If it is negative, it will turn red. Pretty common. But a lot of times you also see bar charts in just one color. It just kind of comes down to personal preference. So going back to the candlestick chart, It shows you the exact same information, except it's quicker to identify. So you see a lot of black there. That tells you a lot of negativity. A professional trader can use either one, but most traders prefer to use candlesticks these days. Really, at the end of the day, it's the same thing. So in this case, we know it's a positive candle. Well, why do we know it's positive? Besides the fact that I just looked at it. It's white. It's the lighter color. Notice how there's a little bit above the top and a little bit below the bottom. So what this means is that you have a range from here to here, from open to close. You went a little higher, a little lower. The fact that it's white tells you this is where we started and this is where we ended. How do I know this? Because it is a positive color. It had to rise in value. Just like this one here, and I'll draw a little arrow, has a body that is somewhat stubby, and it is dark, the body, so that means that it opened and then closed lower. So the opening price was the top of the body. The closing price is the bottom of the body. However, we did rise a little bit above and fall a little bit below. This candlestick here, negative body. So we already know that the open and the close prices, the open's higher than the close, so the top of the body must be the high, or the open, I'm sorry. And then the low must be the close. We did try to rally. So if I were to draw this as a bar chart, it would actually look like that. Open, high, low, closed at the low. This candlestick here, slightly positive. How do I know that? Number one, it's the white color. It doesn't have to be white. It's a personal choice, but that's the black and white convention. As a bar, it would look something like that. Why? Because we have a little bit on both sides of a positive body. So we open at the bottom and close at the top. Again, why? Because of the color. We know that we gained. It also shows that we tried to break down and break up. So you can see, it's handy, but again, it comes down to, do you want to be a bar chart or candlestick trader? You can right click on this and go to settings, and you can go to symbol and go to body, and you can change the color. That could be green and that could be red. Same thing. It tells you the exact same information. You can, sometimes you'll see like white and then like a dark blue. Not as common, but it does happen. White being positive, dark blue being negative. And that's the beauty of TradingView, because it allows you to change this to whatever you want to be. You don't need borders. You could have borders the same color. Now, candlesticks also have wicks. So let's go into a forex pair, dollar yen. Go ahead and clear some of my work up. Notice this wick here. Notice that wick there. What does that mean? Well, if you think about it in what happened during the session, this is a daily candlestick, but it's the same thing with a 5-minute candlestick. So let's take a look at this candlestick here. We started up here. We fell. We know this because the body's red. So we know that the open's up here. The high just happens to be the same price. The low is all the way down here and we closed here. So what this means is the market basically did this during that day. Long wicks they don't have to mean anything, but they can mean that there is support coming in this case, because if you think about it, buyers are coming in to pick this up. Sellers cannot keep it down. Now, we made another attempt. but we have bounced again. This is the power of the candlestick more than anything else because it shows it so clearly. Take a look at this nasty wick here. We tried to sell off this particular day. We originally rallied and then we plunged. And then we turned right back around. What does that tell you? That tells you that people down here are willing to buy, in this case, the dollar against the Japanese yen. And we did, in fact, rise in value from there. Actually, it's not a perfect hammer. That's a little bit more like a hammer, but it's a type of candlestick that a lot of people really like. The inverse of that is the shooting star, actually, which just has a long wick on top of it, showing that the buyers could not push the market higher. So that's a bit of a shooting star. That's a neutral candlestick. Notice how buyers and sellers are both very aggressive. So it shows that we are starting to squeeze. That tells you a move is coming, although that's more neutral. You don't really know which direction, just that something's about to happen. Here, several times the sellers tried to push this market down, and the buyers came in and stepped up and ended up putting these two hammers in a row. So that does suggest that perhaps there were plenty of buyers willing to get involved there. As a trader, your job is to listen to what the market is trying to tell you. If it's telling you a couple days in a row, hey, there are buyers willing to step in and get involved in this market, then you have to start thinking, okay, well, I don't want to be a seller. You don't necessarily have to be a buyer, but you definitely don't want to go against the underlying potential momentum. So here's a shooting star. It's the opposite of a hammer. The buyers came in, tried to push it up. They continue to struggle right here at about 42 cents, and you can see the Cardano fell. These long wicks mean things. Now, the fact that we plunged as low as we did, and on top of that, on high volume, and then turned around, show signs of life, that suggests that there are people willing to buy down there, and they did, in fact. And if I remember correctly, I think that ended up being right around the bottom. Yeah, it was the low print. As things stand currently. The body, of course, is important because if you get a long body that closes near the top or bottom, in the case of a bullish or a positive candlestick, this closed fairly close to the top, that shows there's actual conviction. As opposed to these long wicks, there's no real conviction there. This one here, there was conviction there. There was conviction there. There was conviction in both of these, which tells you that something is going on. We're in the midst of a big fight. We closed almost at the absolute highs here that day. There was conviction there. So pay attention to these things. A wick or even a lack of a wick can be a huge signal in the markets. Keep in mind that the psychology behind candlesticks is just showing where people sometimes don't want to buy or sell. Sometimes where the market won't go is the real signal. In this case here, that was definitely the case. But at the same time, if you see long red candles, that tells you that people are not willing to buy it. Something to measure against any trading plans. So in the next video, take a look at how to use the drawing tools on the TradingView platform. Hello and welcome back to the course. In this video, we're going to take a look on the TradingView platform as to how to use the drawing tools. Now, drawing tools, there's different types of tools, but generally what you're going to be drawing, for the most part, is going to be support or resistance, but there are trend lines. So, for example, a trend line would be shown here. You can see that people kept buying Bitcoin as we go along, and the idea, of course, is that there is support, there are buyers here, and when we come back down to this trend line, you would anticipate some type of reaction, just like we had seen several times. Now, in order to get a trend line, this column over here, the left-hand column has the trend line, but it also has trend line tools. So there are different types. So a trend line is just what you saw me draw. You click, you drag, you click again, and it puts it on the chart. You can erase it. You can change the look. I happen to have it at a medium gray at 2 pixels. You can make it 1. You can make it 4, whatever. Let me go ahead and get rid of that. And talk about, when you click on this, you can click on the arrow. You talk about the ray. So a ray is just simply the same thing. You click it again and it'll just extend it out indefinitely. Now, the blue color here you see is the default color. Again, let's just say I want to keep everything the same. Then I could go to there and click on, I believe it was that one. And you can see it's a ray, even though the points are just connected here. So let's go ahead and get rid of that. There is a horizontal line tool as well. Let me go ahead and go through just the list here. There is an extended line. Okay, so an extended line is the same thing as a ray. It just extends in both directions. The other most common one that you're going to be using, either trend line or ray, and that really, for the most part, is like a personal preference, is the horizontal line. Now, the horizontal line, you click on it, it just draws a line across. You can see I have mine in turquoise. Let me go ahead and change it over to the color we've been using. You can see that you can click on it. You can drag it. You can go into the settings wheel and put a specific price. So 34,158, if that is what I want to put. And that's exactly where it's at. You can see it's highlighted there. There is the horizontal ray, and horizontal ray is the same thing, except it will start at the point you plot it at. Again, you can change the color, the thickness, et cetera, et cetera. So it goes from there further out into time. All of these are used to mark up buying and potential selling pressure or resistance. You know, we could put it up there. And we could put it down there, and if we believe that Bitcoin, for example, is going to trade it in this range, you could mark your chart up like that, and it can tell you when you're getting close to an area of interest. That is range-bound trading. You're just simply going back and forth. So one thing that you can do, let me go ahead and change assets here. Let's go to stocks. Go to Amazon. So one thing you can do is you can use a trend line to perhaps, and I'll use an array just to kind of show how this plays out. This is your trend line here, and Amazon had been in a nice run. Notice how we broke through it. We came down, and once we broke through it, that was a negative turn of events. It was a trend change, at least in the short term. But notice something. As this ray expands out, once we got here, it became support again. So it's market memory. Markets love areas. Normally it's price, but trend lines do have the same effect. You know, it's rising over time. The reversal was when we broke through that trend line, but then again, when we broke through the trend line to the upside again, I'll put this on the chart. It was a reversal again. We reversed from going negative to positive. So you can see how handy that might be. There are things called channels. And a channel is basically support and resistance. So you would click on the chart to make your trend line. And then you just drag higher. And you could say, hey, this is the channel we're trading in. Maybe not the cleanest channel. But, yeah, here, we can just use this. So you do this trend line. Right in a channel, I would point out resistance, selling, buying, support, resistance, buying. We broke out. Now, looks like we're finding support at this previous resistance level. It's that market memory thing again with a trend line. And this is a parallel channel. Let's go ahead and take a look at a regression channel or a regression trend. So you would click this out. Basically what this does is this tells you, if this is your fair value point, and you will see this quite often, where the markets tend to just kind of hang out between going up and down. This is negative, that's positive. Gives you the idea of which side of the market you want to be on, assuming you're going to stay in this channel. Probably not as commonly used, but it's probably more useful, quite frankly, on a shorter term chart. At least that's my personal opinion. So, for example, you could use like a 15-minute Amazon chart, and you can see the range there. You'd be a buyer up here, you'd be a seller down there until you get to that line. You'd be a buyer until you get to that line, and so on. There are flat top and bottom channels. So basically, it shows you support and resistance. So if you remember earlier on the Bitcoin chart, I drew a ray there and a ray there. This does that for you. Not really something that's used a lot, although there's no real reason not to use it other than the fact that you typically will use horizontal lines. Certainly something that, I don't think it makes any difference. It just kind of cuts out one of the steps. There are also rectangles. So let's take a look at a forex market. So Aussie dollar, let me go ahead and get rid of all of my previous markups and the volume. We don't use that in forex. So you could make an argument that wrong one. You could do like a horizontal line, let's just say here, because that's been resistance and support. And you can make a horizontal line here. And you could say that we were in a range. You could even drop it down to here and say we've been in a range until recently. That's fine. But go ahead and remove those drawings, and then you can do things like draw a shape. So, for example, on this brush, you pull down and that rectangle can be just drawn the same way, dragged and drawn. Rectangles are very useful patterns. Traders really like them. Day traders use them all the time, especially. But it's like anything else technical analysis related. On higher time frames, it tends to be a lot more reliable. So do keep that in mind. As I zip through this, you can definitely see times where a rectangle makes a lot of sense, and it gives you an idea of where we're going, where we're not going. There is a fill color. It doesn't have to be colored, or it could be really dark. You can change the opacity to the point where it blocks everything out, or, as light as you want. You can change the outer barrier as well. So let's make that really dark, and let's make it 4 picks, and you can see how the box really comes to life. So rectangles are just something that you use to determine buy and sell areas when a market isn't doing much. A lot of times you'll see like traders use an EMA at the same time. How this thing's just kind of chopping around. It's not really going anywhere. It's flat. It's flat-ish. On the 1 hour, it definitely is. On the 4 hour, it probably should flatten out even more. Oh no, it's still an uptrend. But, you see how it's not really going anywhere. You start looking for support and resistance. You trade back and forth. A lot of traders will, in an environment like this, they'll actually put the rectangle. A lot of them won't bother selling. They'll just take profit. They'll buy. They'll take profit. They'll buy. They take profit. Now that we're broken out of it, we'll look for another area of consolidation. It really comes down to your style, but the rectangle, of course, is a very common pattern. In the next video, I'll start taking a look at the Fibonacci tools on TradingView. Hello and welcome back to the course. In this video, we'll take a look at the Fibonacci tools. And Fibonacci is the theory is that there are certain sequences that repeat in nature, and because of this, they hold a predictive value in the markets. There is a lot of debate as to whether or not this is true or not, but what I do know is a lot of people out there pay attention to it. So, is there any magic, or is it just a self-fulfilling prophecy? This is the first thing you need to ask yourself. Without going too headlong into the actual theory, I'll give you the quick and dirty 30,000 foot overview of what fibs are, and we can go from there. So, a guy named Fibonacci in the 12th century discovered that there were certain ratios, percentages, that nature repeated time and time again. And you can see them like on mountains. This could also be a river, like measuring the bends of rivers. Crops, like the way they grow, the nautilus, all kinds of things will follow Fibonacci ratios. Mathematical sequence could be something like 1 and 2 equals 3, right? So you add the two together. 2 and 3 equals 5. 3 and 5 equals 8. 8 and 5 equals 13. These are all Fibonacci numbers. Basically, you're adding the first one to the second one to get the third number, and then you're going back and adding the second one and the third one to get the fourth number, then you're adding the third and the fourth to get the fifth, and so on. Now, there is a whole debate going on about whether or not Fibonacci is real. And like I said, that being said, it really doesn't matter. What matters is enough people believe that it's real. So therefore, it can be used as an indicator. It should never be used as a primary indicator, period, full stop. This should just give you an idea as to where you might see some action. You have to identify, in order to use it, a swing low and a swing high. It does work in both directions. So this would be a swing low and this would be a swing high. Well, how do I know that? Well, we have turned around from here quite stringently, and we have pulled back from there quite stringently. Your first problem is going to be identifying whether or not it is an actual swing high or swing low. Let's ignore this part of the chart for now. There is the Fibonacci submenu. We'll click Fib retracement. You click on the swing low. You drag to the swing high, and you'll notice that there are subsequent levels underneath. I have taken out multitudes of them because there's really only 3 that most traders pay attention to. 0.382, which is 38.2%, 50, which isn't even a Fibonacci number. It's just the number that people used to use in the past a lot, and 61.8 or 0.618. What do these numbers mean? Well, what it means is we have pulled back 38.2% of this total move in this area. It has offered support. Is there any magic to it? Probably not. But it just gives you another reason to think that, hey, maybe this is an area that's worth paying attention to. I would also point out, though, that there is a lot of support in this area right around 1.05. So draw your own conclusions. Was it the level or was it the fib? My suggestion to you is that it was a combination of the two. Fibonacci traders got excited. Support and resistance traders got excited. You get enough people excited to buy the euro, it does make sense that there would be a reaction. Now, like I said, it does work in both directions. Although your best bet in general is to go with the overall trend. So, and honestly, that's going to be true with really any trading decision. So we have Facebook or Meta here on the daily chart. You can see that it's very positive. Let's go ahead and grind down to the 1 hour chart. Say you're a day trader or you're a short-term trader. We had a swing low and took off from there. So now you're wondering, how do I get in on this move that's already taken off? Well, you could pull up a fib and say this is 38.2. This is the 50%. We're kind of in that area. So again, not perfect, but it gives you an idea of where traders might be interested. You can also use it, like I said, in a down move. So we had a swing high and we broke down, right? So you could take this and you could say, we're in a downtrend. I want to short it. We're just shy of the 50-day EMA. Again, I'd also point out right at $300, support and resistance tends to appear at large round numbers like that. And we make a move down to, the 100% level, basically, within a few dollars. It is very subjective. A lot of times what you'll see is traders do what they call confluence. So let me pull up a crypto chart and kind of take a look at that. Let's do Ethereum. So let me remove any drawings that I have. A trader that has been following this since this move, 61.8. A special thing about the 61.8 or 0.618 is that it's considered to be the golden ratio. And this goes back to that whole, what Fibonacci found in the 12th century was, people, and we've even found mathematical formulas where people find that 61.8% of the space between the eyes, from the middle of the eyes down to the nose, is supposed to be perfect in the eyes of a human, like more people are attracted to that. This all goes back to a lot of that. But what you'll have is, you'll have somebody who is involved here, or, maybe here, whatever. It's not going to make a huge difference in this case. But you also have traders who get involved later and pay attention to the swings later. So notice how the 61.8, or excuse me, the 50% here is right here at this previous resistance barrier, the 0 level, where it took off to begin with. People may look at that as a buying opportunity because 2 sets of Fibonacci retracements are there. Other traders will look at it through the prism of market memory. Well, this was an area that mattered. So why wouldn't it matter again? And you can see clearly right around 1725 did in Ethereum. So again, what you're really doing is you're just using Fibonacci to stack those people into the same chart and see what they're thinking. That's my personal opinion. That's how I've seen it work out. Because the problem that you do run into, and nothing's perfect, and I'm not trying to slight Fibonacci. I think it's a great tool, but it's just that. It's just one of the tools. But you can't jump into, let's go back to this swing trade here. Well, you could have bought at 38.2 from this pullback, but it actually went about $150 lower than that. So generally what you're doing is you're looking for a Fibonacci level, like right here at the 50%, and a hammer. That would be a signal to get long. That's a bullish candlestick. In that case, you can start to build a case. In 1400, I'm going to take a wild guess and say that's mattered previously. Yeah, support and resistance. So again, you want to tie all this together. You can't place trades based on one simple indicator. Now there are Fibonacci extensions. And a Fibonacci extension just shows you if you've missed a move, how far I can go. So what I mean by that is so you click on the swing low, the swing high, and you drag it back to the swing low. This is 38, but went 2% of the move. This is the entire move, right? So the idea is you could go to 1.61. You can see it almost did, just shy of there. But I will say this, extensions are not used anywhere near as much as retracement. They are a tool that you can use, but it just gives you an idea of where a market could go. You can see we're above there now, but if we break out to a new high from here, a lot of times people will pull this up and say, okay, well, where could it go? Well, it basically went there. It has gone over there now, but, you had to be willing to hang on to this for, 7.5, 8 months. If it's an investment, fine. But you can see where that could cause some issues. Let's go back to the stock market. Let's just find a random stock here. Disney. So let's go ahead and say you saw this big sell-off in Disney and you wanted to join. Well, right here's where we broke down. So when you break down below here, the idea is that you could get down to $74.62. We don't know that it will happen, but that would be the prediction that it shows. You could make an argument that this tends to work better on short-term charts. I think it's just mainly because you have to reach so far to get the extension. You could do this on the 1-hour chart, this swing high, but one thing that would concern me is that we almost completely wiped the move out. So while this is a level that seems to be offering support resistance, you can also make an argument that it's been support and resistance in the past anyways. So the extension, not as keen on. I don't think as many people follow it because, I don't think there's any real takeaway from this other than there are enough people out there that follow it that it does work. I don't think there's any magic involved. A lot of times what you'll do, and let's just say you shorted this, and let's use the retracement because it is a more common use. You short it here, it starts to break down and put your stop loss on the other side of this fib level. In this case, you're waiting for it to break down below here. Once it does, you put your stop loss just above this fib level, and then you hit that area. That could be a decent strategy to take profit and move stops. Like I said, it obviously works in both directions. So, take a look at this. This is 38.2. You get a nice hammer. You say, all right, I'm going to buy it. You put your stop loss here. You break out above the swing high. You put your stop loss somewhere just below it. You probably get taken out. But it would make a certain amount of sense to take profit at 200 just because it's a large round number. So again, please don't put too much into fib. Just recognize that enough people follow it that it should be thought of as a secondary indicator. It's very difficult to just trade based on it. And there are some people out there that do it. It's not like there's anything wrong with it, but you have to have the ability to stick to your plan. And, a couple losses in a row gets really difficult. Here's the 50% Fibonacci retracement level. You can see that we took off. Kind of a perfect example. Let's put that extension on. You missed the move or break it out to a fresh new high. This is your target. Okay. It does work, but I would submit that you're breaking out to a fresh new high. You form a hammer. You have shown yourself to be supported. And then you rallied up here. You showed a shooting star, a negative candlestick. It's time to get out. Did the extension cause that, or did this swing high cause that? Really, the answer is maybe both. So line them up. That's my personal opinion. In the next video, we'll talk about a very commonly used technical indicator that you can use on the TradingView platform, and that is the moving average. To the course, in this video, I'll talk about using moving averages. Now, a moving average is just simply a dot that is plotted on a chart that then gets connected to be a line. So what I mean by that is it's like a line chart in the sense that most of the time it'll be closing price. It doesn't have to be, but 99% of the time that's what you'll see. So this is the closing price, this is the closing price, this is the closing price, and this is, and so on, and you'll see the line go higher. But exponential moving averages aren't just the price. You might see something like a 20 exponential moving average or simple moving average. And all that would be the average closing price of the last 20 candlesticks from here, from this dot, and so on. And what it shows you is that over time, prices are rising. So the first question you probably have is, what's the difference between an exponential moving average and a simple moving average? And the quick and dirty response and answer to that is that it is as simple as exactly what you would expect. It's the actual average price of the last 50 candlesticks. But an exponential moving average, pictured here, puts more weight on the more recent ones. And the reason is it makes it a little bit more reactive. Now, I'm going to tell you a secret that most people won't tell you, and that is that it doesn't make a huge difference most of the time. You have a scenario where here is your EMA, and let me go ahead and put a moving average here. Moving average simple, right? Okay, so you see it listed as SMA. Let me go ahead and change that to 50. And you can see they're pretty close. It's a little quicker to react on the exponential, but not enough to get overly excited about. So we can take some of that mysticism out of the market, because it's something you hear a lot of. Oh, you have to use EMAs. That's not true at all. It really doesn't make too much difference. So with that being said, the EMA is more commonly used for whatever reason. So they do follow the trend. So in this case, this is a 50 EMA. This shows that we are in an uptrend. You probably can figure that out by price. But it does help kind of set up other indicators. So for example, if you were to use a range-bound indicator, something to the effect of like a stochastic oscillator, which is a common range-bound indicator, when you see the moving average go flat like that, it gives you an idea that you're in a range. So it makes more sense. If we're trending like we are here, then that's not an indicator that you would typically use. That's one way to use it. They also tend to be used for dynamic support and resistance. Like this is a perfect example of a range-bound market. Flat. We're not going anywhere on the 50-day EMA in Coinbase, and you'd be range-bound trading then. This is an uptrend, this is an uptrend, and so on. This is a downtrend. But another use that people will use it for is dynamic support and resistance. Look at this resistance. It held up pretty nicely. So the easiest way to do it is just click on indicators. Now, I happen to have it saved, but you can see you just type in moving average. You saw me do it earlier. And then click on exponential, and it will add it. And then you go to the gear, and you select what you want. So in this case, let's just keep it a 9. Let's make it red. Click OK. And you can see that it is much quicker to react because it's only taking data in from the last 9, candlesticks. So with that being said, you just change the number and it changed the periodicity. There are a couple of well-followed moving averages out there. And without a doubt, the big one especially when you're talking about like daily trends, it's going to be the 200. The idea being that that's a year's worth of data roughly. The stock's above the 200. It's in an uptrend. A lot of times people will use 50 as well. Well, why do they use 50? Because 50 is a quarter. So that's 1/4 of the year. There is something known as, let me find a stock with a little bit more history here. There is something known as a golden cross and a death cross. And a golden cross shows that the shorter term momentum, the quarterly momentum, the 50 EMA, crosses above the 200-day EMA showing buying pressure. Just like when it breaks down below the 200-day EMA, it shows that sellers are in control. It is a longer-term lagging indicator, and I would highly, highly stress that. That's your long-term signal. You're not taking day trades based on this. That being said, some people will do something like a 15-minute chart and they'll do it, but you're not looking at this on the daily chart and saying, okay, I'm jumping in short. You might do something like this on a 15-minute chart. And a lot of times people will use shorter intervals, so they'll use like a 9 and a 20. They'll just use the 9 for the quick and 20 for the longer term. Really comes down to which one. I will tell you something else that you never are told. It doesn't matter what you use as far as the number. There are a lot of people out there that swear up and down that a specific number is like the secret banks don't want you to know type of thing. 200 is just a year. 50 is a quarter. It's really that simple. And what happens is a lot of times the 200 will cause a reaction. You look for price action to confirm that in this case there's buyers there. You find the right candlestick, you find the right trading setup. Notice we gapped above the 200, came back and found support here. It was an earnings call that made that happen, which makes sense in the stock market. So, you can also use this for crypto. The problem with crypto is most crypto is far too volatile for something like this. Like, this does kick off a bearish move down here, but it also went against it before falling. It just moves too rapidly. But when you see them spread out like this, it means that the short-term momentum is really starting to take off. And that tells you just how bullish you are. And when you're bullish on a longer-term chart, then it's your job as a trader to come in and try to find a reason to buy it on a short-term chart. Forex does, it's a longer-term type market. So it does make a certain amount of sense that you may see it come into play here. The 50-day EMA, the 200-day EMA crossed here. We did drift a lot lower. We're still very negative. We were very positive here in dollar Swiss. That being said, it does tend to attract buying and selling, the big major ones, but more than anything else, it just points you in the right direction. In the next video, we'll talk about using an oscillator called the MACD, or moving average convergence divergence indicator. Hello and welcome back to the course. In this video, I talk about using the MACD, and you can see that on this chart, I have an extra window, and this is the moving average convergence divergence indicator. So what does it measure? Well, it measures two periods, two time frames, if you will. In this case, the 12 and the 26, that's your standard. And then there is a smoothing mechanism. So this isn't quite what the moving averages would look like on the chart. It's more of like a smooth representation to take out some of the volatility. Long story short, the histogram, this part here, measures how far apart the moving averages are. So, remember when I told you in the last video that as the moving averages separate, like you have two moving averages and they look like this, and then all of a sudden they separate and start going higher? Well, that'll make the histogram, this part, rise. And the reason is it shows momentum, and it will do the exact opposite. So, in this case, it would start to fall. It just shows the speed at which they are diverging. That being said, why does that matter? Well, it measures momentum. And you can see there are a multitude of things going on. There's a zero line here where the histogram changes. Some traders just simply take a trade as soon as the line crosses in one direction or the other. So they would sell here. They would buy there because it's breaking to the upside. Other traders wait for a cross, like the moving average crossover. So they see this and they're just like, okay, maybe it's time to sell. Maybe it's time to buy down here. Maybe it's time to sell, would not have worked. Maybe it's time to buy, would have worked. So you would have had 3 out of 4 on that. There are also instances of divergence. So, for example, notice how price is rising here, but the histogram is falling and the moving average is falling. That is a heads up that we might be running out of momentum. And you don't necessarily want to jump in and short right away. But what this does tell you is that if you are already long, if you have already bought the market, you may want to consider tightening up your stop losses or taking some profit. If you are looking to short the market, you're still looking for some type of setup, but it tells you that momentum is starting to slow down. So it's something, think of it as a early warning detection system. Go to stocks. Let's go to NVIDIA, and you can see that we got this cross here right at an area of previous support and resistance. On this cross, it took off and really hasn't looked back since. Now, there's been several times where the market's crossed over, but then saw a drop in momentum only to buy back in. You know, this brings up the interesting point that technical analysis can only do so much. You also have to know what's going on. Like in the case of a stock, earnings really matter over the longer term. A long-term trader like this may have used this as an entrance, or even this as an entrance. As far as selling here, probably a bit tough, mainly because look at how thin the histogram is. It shows you that the market, the moving averages, if you remember in the video, but moving averages, sometimes they just do this. And that's what that looks like. It looks like nothing. So that is nothingness. Markets do a lot of nothingness. You can see we shot straight up in the air, kind of went sideways here, and then drifted a little bit lower. You know, maybe you got out then, but nonetheless, pay attention to nothingness. Nothingness is a state of the market that you have to pay attention to. Pound yen. So this is a good example here of divergence, bearish divergence. Specifically, it means that it looks bearish. We're rising in value, right? Everybody's rising, and we continue to rise after a slight pullback, but notice how the lines are dropping. Well, it didn't lead to the death of the British pound. They just led to some consolidation. So again, it doesn't necessarily mean that it has to be something ugly. It's just that what's driving the market is running out of efficacy. Over here, this would be bullish divergence. We're falling, right? But notice how we're turning here and we're still drifting. So as the MACD starts to turn more positive, it is bullish divergence. This is a good indicator to use as a secondary indicator. So for example, if you have like a candlestick formation or a support level, actually this is a perfect example right here. Now that I look at it, this was support. This should be support. We formed a hammer. We got a cross. The hammer is a bullish candlestick. We bounce a little bit. The momentum picks up. Cross is right there. So that was a nice, tidy little, in this case, 500 pip move. So that's a really good way how to use MACD. Just use it to confirm what you're already seeing on the charts. In the next video, I'll start to take a look at Bollinger Bands, which are probably one of the more nuanced indicators that you can use, but they are good for volatility. Of course, in this video, I'll talk about using the Bollinger Band and, the different ways to use it. And there's multiple ways that people use Bollinger Bands. They do give you a lot of different information, so that's definitely something to think about while we look through it. And I will walk you through the most common ways. People use this common indicator. So the first thing we do is we go to the indicators, metrics, and strategy button up here. I have Bollinger Bands saved, but of course you just type in BOLL and you start to see multiple Bollinger Bands. There are strategies and everything else, but we are just using Bollinger Bands, the originals. Notice how there is 3 lines in a filled area. That's because this measures volatility. And the whole idea, if you remember math, that this is 50% of a distribution, and all but just the last remaining percent in both directions fall within the 95% roughly area. So the idea is that the market's going to trade in these numbers here, or in this case, values. So what you're measuring is standard deviations. 2 deviations in both directions is the standard setup. So this would be -2. This would be +2. So 2 positive standard deviations. The middle line is actually a 20 moving average. So, and you can change that. You can pull this up. The 20 simple moving average, very common indicator to use. That's considered to be normal. 2 standard deviations in both ways tells you when we may be overbought or oversold. That being said, there are other ways to look at this in the sense that notice how 2 standard deviations here where I have the cursor is much smaller than this. It measures volatility in that sense, meaning that the market is compressing and then it suddenly gets more volatile. It's compressing and then it suddenly gets more volatile. There is a strategy that people use called a squeeze. When the Bollinger Band squeeze and we finally break down through it, you short. In this case, when it squeezes and we finally break through it, you buy it. In that case, that's one way. And the reason for that is simple. Markets don't sit still forever. It just don't. So with that, I think you've got a situation where, it's probably how most traders will use it, but there are other ways to use it as well. Let me go ahead and switch over to stocks. Let's find something with a long history that we can get involved in. Walmart. Here we go. So you can see that the Bollinger Bands go up and down, and the moving average tells you the direction overall. That makes quite a bit of sense. I will say this, with stocks, they're naturally going to go up over time, most of the time, assuming that the company is not melting down. But a company like Walmart obviously isn't going anywhere. So more often than not, they're in an uptrend. And people use the Bollinger Bands to great effect in that scenario. Notice the moving average is rallying. We're kind of hanging out here at the bottom of the Bollinger Band. That means we're oversold. At least it can mean that in theory. You get a couple of green candles and you go for it, and you notice that we stop right here at, I guess you could call it fair value. It's essentially normal, standard deviation or standard distribution, I should say. We rally from here, and then we get to the overbought condition because we're 2 standard deviations above, and we get this nasty candlestick. So the idea is you could be a buyer here on a reasonably bullish candlestick and a seller here. Now, some people will just short and they'll aim for the 20 SMA. It's much more prudent to follow the overall trend. So basically you buy and you get rid of it. And then you wait for it to get oversold again. Big massive red candlestick, a big green candlestick does suggest that perhaps their buyers are fighting. You could buy it there, sell it there. And that's just an oversold or condition, returning to an overbought condition. Let's see if we can find an example in the other direction, perhaps in the forex world. So dollar Swiss franc has been negative for quite some time. Notice the trend change here. This is a market that was somewhat squeezing. And then you can see we widened out and then really kind of kept following this trend. This was an oversold condition in a moving average that was rolling over. It went sideways. Now, that's something that I would pay close attention to, because it is a lot different when a market just goes sideways and the moving average catches up, as opposed to racing towards the moving average. So moving average catches up and we hit the low here, and then we break through the bottom of the 2 standard deviation and do what is known as walking the band. That's an extraordinarily negative turn of events. Now notice that the moving average has gone positive after forming a hammer here. This is a candlestick that's very bullish. Some traders would use that as a buying opportunity and get out once we close outside of the 2 standard deviations. That being said, Bollinger Bands are a bit messy, and you do typically want to use them with other indicators. And more specifically, and I can't tell you this enough, you really want to use it with support and resistance. So, for example, when we did rally here, there's some resistance here, so it's not a huge surprise that we fell. Bollinger Bands can be used for short-term charts. This is a 15-minute chart. On short-term charts, I do favor the squeezes, mainly because markets can be very noisy, but when they're very quiet and suddenly wake up, you do need to pay attention. So a lot of times, what I will do is I will use this squeeze, and then I will start looking for a place, where can this market go? Like previous support resistance. So let me go ahead and mark this here, because I see this is an area that's been both support and resistance right around the 87 level. So it's a big round number. That makes sense too. So notice we're going sideways and we get pretty volatile, and then we get this nasty candlestick. Well, we go directly down to 87. We do go lower, but it just gives you an idea of what you can be looking for. Bollinger Bands are a little bit squirrely in the sense that you're either good at them or you're not. For myself, I've always found them to be a good help, but I generally like the longer term ones. Short-term day traders definitely can use them, but in that case, I have found, at least personally, the best outcome I've always found with squeezes. Daily charts, you can say the same thing, but you can also just trade the trend as you go along as well. Bollinger Bands really need a trend. They're difficult to trade in a consolidation phase, except for the squeeze, because that tells you you're leaving that consolidation phase. Ultimately, there are a million ways to use the Bollinger Bands. You can just simply use them for an idea of trend. I mean, they really are basically a moving average and some standard deviations. You can see that the trend is definitely dropping in the dollar yen. So perhaps if you get towards the middle moving average, if you race towards it and show signs of exhaustion like a long wick, then it might be a selling opportunity. There's a lot of what ifs when it comes to Bollinger Bands, but they can be used in conjunction with other support resistance indicators, that kind of thing. Like, you'll notice that this is an area that's been important a couple of times. I realize I'm not drawing it perfectly, but right there and there and there and there, and that's where we're at. So if we bounced to the 20 SMA and formed a candlestick with a long wick like that, then it might tell you that we're going to race back down to the bottom of the Bollinger Band. Who knows? It's in the future, but it does give you an idea of what you can use them for. In the next video, we'll talk about a couple of momentum indicators, the relative strength index and the stochastic. Of course, in this video, I'm going to talk about using momentum indicators in the TradingView platform. Now, a momentum indicator is essentially a way to measure whether a market is overbought or oversold. There are mathematical formulas that an indicator will use to determine whether or not a market may have gone too far in too short of amount of time, either up or down. And the mathematics behind it is a little bit different for each one, but suffice to say that's the part that you need to understand. So in front of you, I have the euro dollar daily chart. I'm going to go ahead and click on this, and the first one that I will look at is the RSI, Relative Strength Index. And you see it brings up a window down here that you, of course, can change the settings. So, for example, you can put the RSI-based moving average, which is that yellow line on top of it. Most people don't use that. But it is something that you can do. Not particularly useful under most conditions, but what people truly pay attention to is the signal line. So notice that there is a band here between 70 and 30. A reading above 70 signifies that the market is potentially overbought, and a signal or a reading below 30 signifies that the market might be a little oversold. These are potential turning points, or depending on when you got into the trade, they might actually be take profit signals. So, for example, if you were long in this market, had you bought the euro, and this is the daily chart too, for that matter, but you got this signal up here, that tells you we may be due for a correction. If you shorted it, down here, we got the oversold condition, and the market turned around and bounced. So it isn't even necessarily something that you need to take as a trade. It might just be a sign that, hey, it might be time to start thinking about collecting profits. So it is used that way, beyond the fact that some short sellers would be looking up here for a reason to sell. This shooting star might have been it. This big candlestick next to it, and then the one following certainly confirmed that, and down we plunged. It does work on shorter-term charts. That being said, it happens more frequently on shorter-term charts, so you have to understand that it is less reliable, but that's going to be true with all technical analysis tools. We were oversold here. We did bounce right about to the median and then fell again. You can see that we did pull back a little bit here, so you could have gotten long down here for whatever reason, and so on. Let's go ahead and take a look at a cryptocurrency. Do Ethereum. This is the daily. This is the overbought condition, but notice something. It went higher anyways. So that's why typically you're going to, it did pull back. In all fairness, I suppose, but it went higher after that. So you do have to use it in conjunction with like support and resistance, price action, like what the candlesticks are doing, that type of thing. Like anything else, you don't want to just say, hey, we're overbought and time to start shorting. It can, like I said, be a heads up. If you were short here in this overbought condition and rode it all the way down here, we're oversold, might be time to take profit. Or if you're looking for a reason to buy, it might be time to start buying. And again, it works on short-term charts as well. Little overbought condition here. We pulled back, and so on. So it's pretty straightforward. There is a condition known as divergence in RSI, indicators. And basically, what divergence would be when price is doing one thing and the oscillator or the indicator is doing something different. So let me go to the stocks world here, and let's see if we can find a good example here. So notice this market, HDFC Bank, okay? Notice that it had rallied quite significantly during this time frame, but notice how the momentum was actually dropping. It peaked again and then it dropped again. That is divergence. That's the momentum not behaving the same way as price. Notice though, it took a while for this to play out. So that is something that you need to keep in the back of your mind. The thing about technical analysis is that there is no such thing as 100%. So for example, here we had a rising price. We had an overbought condition, slightly less overbought, showing that momentum is running out. And then we eventually just went sideways. So you could have used it as a sign to get out. You know, had you shorted this, probably wouldn't have worked out. You know, you need to be aware of the fact that there are times when it just doesn't work out. So with that, let's take a look at the next momentum indicator, and that would be the stochastic oscillator. So let's go ahead and pull that up. Just listed as stochastic. And stochastic's a bit different in the sense that it has a couple of moving averages in it. It measures from 80 to 20. But it tends to do better in a range-bound environment. So quite often, what you'll see is a moving average plotted as well. And I'm going to make this, let's just say like a 20-day moving average. So once things get a little bit flat, that's when stochastic tends to do fairly well. The market going into overbought and crossing suggests that we are due for a pullback, and we did pull back. We got into overbought, but not with both of them. That's really what you're looking for. Let me go ahead and zoom down to the 30-minute. You can see it gets really noisy on short-term charts, but in a flat market, it'll get you in and it'll get you out. You would have shorted, picked up a little bit here, and got out. So a lot of scalpers like using this in a range-bound kind of short-term market. Let's go ahead and pull up pound yen. Now notice, as the pound is falling pretty rapidly against the yen, the stochastic really isn't doing a whole lot. It's just firing off a lot of noise. So again, that's why a lot of times traders will use a moving average just to give you an idea as to, you know, we're trending, so this doesn't mean anything. We're flat. Now all of a sudden, short it here, buy it back here. So it doesn't look like much, but it's about 75 pips. So as a general rule, you need to see like flatter moving averages. You don't have to use the moving averages. It just simplifies the entire process. It lets you know when you might be in an environment that stochastic is built for. It's built to find the top and bottom of a range, not so much strength or weakness like the RSI is. Both are very useful indicators. Don't really, you can play stochastic divergence as well. However, you have to realize that sooner or later stochastic goes the wrong way from the market because it breaks out of its range. So while it is a thing, it is not as widely followed as RSI divergence might be a best way to put it. And you would just use your peak, for example, or your trough as you connect two lines. You say, okay, well, let me go ahead and pull back out to the daily here. So, yeah, like here's an example. Price was rising. Stochastic was falling slightly, not drastically, but slightly in this area. And we did, in fact, start to sell off. Again, though, not widely as followed as RSI, so I wouldn't necessarily push you to use it. But the stochastic for going back and forth in range-bound trading, one of the better indicators out there. In the next video, we'll take a look at how to use volume indicators. So in this video, I'm going to be taking a look at a volume indicator called the on-balance volume. OBV is a pretty popular indicator, and it is different than volume. So you can see volume here shows up as a series of bars on this Meta Platforms chart. First things first, we've got to put it on the chart. So if you type in OBV, on balance volume comes up. And you can see it's a little bit different because it shows just a line. So for simplicity's sake, I'm going to hide the volume on the chart. And what this is doing is it measures positive and negative volume flow and analyzes the trading direction. So it does show up a single line that can, in theory at least, provide insights into what major movers are doing. The OBV is very rarely used on its own, but in this video, I'm going to focus more or less on itself. Just know that a lot of times you'll see like a moving average attached or certainly support and resistance. So as we're going along here in Meta, notice that there is a huge decline in shares being bought. Well, that suggests that there's less interest. So that's the most basic setup, really. And it does make sense because this earnings call came out, and you can take a wild guess and say that it was negative. So everybody started selling their shares. And the amount of positivity for the day really kind of dwindled, and it continued to dwindle for quite some time. We did find a bottom here in November of 22 in price, and notice that volume continued to go higher. The theory is that if a asset is really something people want to own, more and more people step in and buy more and more shares. Pretty basic, really, concept. There are a lot of things that you can do with that information. And just as there's a lot of things that you can glean from it as well. So, for example, this is pretty range-bound trading here, and you notice we're just like at a kind of steady as she goes type of situation. We dipped a little bit and then started to pick up volume again and rally. So a lot of what people will do is they will use it as confirmation of something else that's going on in the chart, I should say. So for example, let's draw a rectangle here. And why do I do that? Well, we gapped lower, so there was obviously a lot of selling, a lot of resistance here, and typically there is resistance at the top of the gap. Once we break out, we have to see, is volume picking up? It is, and it did pull back, but then it picked up again. So this showed real resiliency, and that's something that you just can't overlook. So that's one example of OBV and, how you might use it. So Aussie yen. Let me go ahead and remove my drawing. There we go. Same situation. Now, be advised that OBV can only be picked up by exchanges. So, in other words, this will either use tick volume or nominal volume traded on the actual server that you're on. So it is a proxy for what would be the case if we had a centralized market for foreign exchange, but we don't. You can see that it is dropping, price is dropping, it's turning around, pretty solid sign that there is interest in owning Aussie yen. If you are a short-term trader, notice that we collapsed there. We did sell off, but we didn't sell off drastically as far as momentum, and then we ended up going sideways. Something worth thinking about is, in this case, divergent. So you can see price was going up, OBV was going up only to about here and then really kind of flatten out. So what does that tell you? That tells you that there isn't this huge surge of buying. At least it's not sustained. And that tells you that you could be in a little bit of trouble. And we did, in fact, pull back. Now, keep in mind, volume is crucial because no matter how much money you have in your account, you're not going to have enough to move the market by yourself. You do need people coming along. And therefore, you have to be conscious of volume. Here is Cardano. You can see it spiked, and obviously a lot of volume comes into the picture. One thing that people will quite often do is use this as, and I kind of hinted at this, but use this as trend confirmation or a, confirmation and a move. So let's take the EMA, do a 20-day. Now, notice we really started to rally in Cardano. And while the move looks like it is starting to pick up, if you know that there's more volume being bought into this market, then it makes sense that Cardano could truly be breaking out. Now, there are a whole litany of other things that you need to pay attention to as well, like crypto in general. In this case, how's crypto in general doing? Well, in general, as I record this, doing fairly well. Now, let's go ahead and go to the weekly. You can see Cardano just did nothing forever, it seems like, and now we're starting to pick up a little bit of volume. So again, it does have potential to confirm a trend. Let's go ahead and go back to the forex world. And let's go to dollar Swiss franc. Less and less dollars are being bought in this particular pair on this particular server. Shows a lack of interest. Shows selling. Now keep in mind in forex, it's not even that less dollars are being bought. It's more like more francs are being bought. So therefore price goes lower as it is a pair. But you can see over time, it does tend to jive fairly reasonably well with the pricing. Let's go back to stocks. AMD, big move higher. Is volume picking up? It is. Now, the one problem you have with this is it's not spiking, but then again, and I should quantify this, it's not spiking in volume quite the same way it is in price. I mean, it is over here, but you're looking at a difference of about 600 million shares because this is in the billions of shares. You can see the number over there. So it takes a little bit more to really get these big boys moving with that type of volume. That being said, volume is going to be your greatest ally if you are in a market. You want more market participants with you. So with that being the case, you can take something like a pattern on a chart or a breakout of, a perfect example is like right here. This was previous resistance. We bounced up against it, but notice volume had been surging. So that tells you there's a good chance that there's enough volume to finally blow through there. Again, doesn't guarantee anything, but it does suggest that at least there's a fair shot at it. If you see, somewhat lackluster performance in volume and it's approaching, here's an example over here. This is an area that's been important a couple of times before. And we were falling, and we did rally pretty significant volume. But notice here, the volume is still lower than it was over there. So it does suggest that maybe we could roll over. You would definitely be cautious about buying. And you can see that, in fact, it did find itself wanting in that area. So OBV is something, like I said, a lot of times you use it to confirm patterns and shapes on a chart, but not necessarily something that works in and of itself. It just kind of gives you an idea as to what's happening under the hood. So in the next video, I want to talk about paper trading on TradingView because that is one of the major benefits. It allows you to practice through various we're going to talk about paper trading on TradingView. So the first thing that you need to know is that paper trading is also demo trading. It's the same thing. It just means that you're putting down trades on a piece of paper. And many moons ago, to do that, you would have said, okay, well, my trading plan is to short the AMD stock at this price because of whatever condition is met. And then I would take profit because the conditions were met down here. And then you would calculate exactly how that performed historically. You know, let's say based on your position size, that was a 2% gain. Okay, fine. And then you go on and you look and you say, okay, I would have bought here. I would have sold here at, a 1% gain based on position sizing and what my rules told me. Up here, I would have bought it. I would have stopped out here. That might have been minus 1%. And then as time goes on, you just kind of add or subtract what's going on and you see whether or not your trading system is historically profitable. Because if it is not, then there's no point in using it. So that is paper trading. Demo trading, pretty much the same thing except if you're doing it on a platform. You'll hear the two terms used interchangeably. Really doesn't make any difference. So it's important for beginners because you need to understand whether or not what you are doing is going to make money in the long run. And it gives you an idea as to whether or not you should pursue with that set of rules. Like I said, if you have a set of rules that averages a loss of 4% a year, well, why would you use it? But if you know that it makes maybe 13% a year, it also makes it easier for you to ride out the volatility because you are going to have losing streaks. So it's a psychological tool as well. Experienced traders will use it to refine. So let's say I have a trading system that would have told me to short AMD here and get out here. But if I add one more indicator or change one of the variables, maybe it tells me to get out down here and I make more. Or maybe it tells me to get out earlier and I make less. You know, it's a good way to tweak your systems and of course explore new ones because even though you have experience doesn't mean that every system idea you come up with is going to make money. Furthermore, a lot of traders are moving on to automated systems. And if that's the case, you need to know before you just let this thing start throwing your money around the market. Okay, so having said all of that, you can click on Trading Panel and you can see that a new window pops up and I'm going to go ahead and make it much bigger. And you can trade through all of these brokers on the TradingView platform. Yada, yada. You can click on see all brokers and then it really starts to open up like if you're trading just crypto, maybe Binance, Gemini, etc. Futures, Optimus Futures, Pepperstone, CFDs, and so on. Okay, so back to paper trading by TradingView. That's basically, like I said, you're just simulating it. So you click on that and you connect. So it will give you a tour. But in paper trading, you can see your account now. Wealthy Education USD. My account balance is 100,000. You can change your commissions. So let's just say I want to make my commissions, something crazy like 5%. You can change that. You can make it fixed. Like, for example, forex, like $3 a lot, if that's what you're doing. And you'll see this gives you the ability to place orders, but not risk any real money, which of course is going to be crucial for your development of a strategy. You can click trade, and then it pulls up the DOM. Now, it is after hours, but if I wanted to buy or sell, so I could buy this limit here, just go on and on and on. You know, I put in my units. So 100, say I want to buy 100 shares, and I want to buy it specifically at 139.58. I want to buy 100 units, and now I can place my take profit or my stop loss, time and force, and let it rip. So let's say my take profit is, you know, this will measure in ticks, in this case pennies. So 75 cents is the default, but I want $5. So this tells you how much you would make on the trade. This tells you how much of your percentage of the account you would be gaining. Now, if I'm going to go for $5, maybe I put a dollar stop loss in. And you can see how things play out. And you can click buy, and it will place all of those orders for you. So let's go ahead and zoom in. And you can see that if it drops a couple of ticks, it'll buy it. It'll take profit there, and it will move the stop loss there. Now, I can manually move all that, and then click modify order. And I can also cancel the order just by clicking the X's. And the beauty of this is you can set this up and you can walk away. It's not going to cost you any money, and you can see whether or not things are going to work out for your system. So here's Ethereum. Let's say I'm trying some type of breakout strategy, and this big candlestick, let's put some volume on. Let's see what it says. Okay, so let's say this has enough volume for me to place a trade off of this candlestick. I want to test something along the lines of a 50% Fibonacci retracement level of a big candlestick like this, which is basically where we have just tested. So I could go in and just buy market, which is just going to fill me at the best price available. Or I could open up the order book and do the same thing that we just saw. But I'm just going to buy market. And there you go. So it filled one coin, Bitstamp Ethereum, at market price. Okay. And you can see it shows me the profit here. Now, you can click on this little pencil icon down here in your positions. And, you know, I realize, hey, I want a stop loss. I don't want to, cowboy this position here. So $2,200, I'm willing to risk $87.50. And now that stop loss comes in, you notice there's an arrow there that shows where I got into the market. And then once I exit, there'll be a red arrow showing to the downside. And that's it. I mean, you're in the market as far as paper is concerned. The projection tools over here on the left-hand side is it gives you an idea of where you could be going. So, like if I were to click there, oops. Let's try that again. It can measure like how much of a gain you're talking straight up or over time. So this would be 17 bars worth. So it's 17 days. 20% gain from bottom to top. right? So it just kind of gives you an idea of how the market could move if, let's just say I project, let's try this again. Let's use this as a breakout. And let's just say I believe that over time, the market could recapture the highs, and that would be a 12% gain. And this is just literally measuring. You can also mark your positions in the chart to give you an idea of long and short opportunities. So here in this one that looks a lot like Fibonacci, there is long position and short position. So let's go ahead and click on that. And by default, it gives you a 50-50 position. But I'm going to move it up to my stop loss. I don't really have a take profit on this one, but one way I might use this is if we test this high here, what does that give me? Well, it gives me a 6.21% move in Ethereum. My risk to reward ratio is 2.15, so that's important. You never want to risk more than you're aiming for, and so on. And it would work the other way. So, for example, if I wanted to short the market, it just changes the colors, and I can drag this down. And notice the risk to reward ratio is 233, and it gets higher and lower as I move along. It's kind of a neat little tool to just let you know where you may or may not end up based on your forecasting. That being said, it's just a measuring tool. And therefore, it's not like an actual indicator, as it were. The measuring tools for TradingView is part of what makes it so interesting, but at the same time, you have the ability to test your strategies. There is strategy testers here, and you can load your strategy, but that involves knowing, I believe it's Pine is the language that they use to build strategies and automatic trading in TradingView. So that, of course, is a completely different thing and something that you need to have some proficiency in. You'll notice that it is happens to be heading into, or it happens to be during the weekend. So Ethereum's not like going crazy here. You'll notice over here on the price, you can add take profit. You can reverse position. So let's add a take profit. Protect position, close position. You can do all of that off of this little kind of thing over here. And then if you hit X, it'll literally just close out the position for you. So you can see how handy this is. And at this case, I'm down $1, but not really. It's not a real dollar. I could have gone in with an insane amount of money. If you want to try high leverage positions, by using the paper trading functionality of Ethereum, you can save yourself years of headache and financial problems, and for that matter, kind of get rid of the risk of financial ruin. The other thing that I would point out is it's kind of neat. There are updates that occasionally pop up. You click on that, it gives you a headline. And you can click on that and it'll open up the story. So pretty robust platform all the way around. Yeah, it is Pine actually. So this is what the script looks like. If you know all of that, you can load it into the strategy tester, but really at this point, then you're talking about automated trading, which is a completely different set of learning tools. So with that, we have looked at the TradingView platform. It is a very robust platform that continues to add. And therefore, it is something that I think will stay at the forefront of trading